Right now, Cintas is sitting exactly one Federal Trade Commission decision away from forging a near monopoly in North America. We're not talking about a major tech giant here or some massive pharmaceutical behemoth. This is a company that literally rents out work uniforms and washes floor mats. Yet through this ruthless combination of route density and operating leverage, they have built an absolutely elite compounding machine. The central tension right now? It all comes down to a pending $5.5 billion Blockbuster acquisition of their main rival, UniFirst. If this deal actually goes through, the competitive landscape in the space changes forever. And this 50% number brilliantly illustrates the sheer scale of the stakes we're talking about. See, Cintas already dominates the space. They're sitting on roughly 31% market share today. But if regulators actually approve this UniFirst acquisition, Cintas is expected to control nearly half of the entire North American uniform rental market. By absorbing UniFirst, they would effectively remove their primary national challenger from the board. This paves the way for unmatched pricing power and would allow them to capture a projected $375 million in annualized operating cost synergies within just 4 years.
But, that is a massive if. On June 11, 2026, the FTC hit both Cintas and UniFirst with a second request under the Hart-Scott-Rodino Antitrust Improvements Act. Regulators are legitimately concerned here. They're worried that allowing Cintas to just swallow up UniFirst would create an impenetrable duopoly between Cintas and a distant, smaller competitor named Vestas. This regulatory hurdle has created a massive curiosity gap and some intense valuation tension for investors right now. So how did a boring commercial laundry business become such an unstoppable financial juggernaut in the first place? And the big question, will regulators actually let them corner the market?
Section 1. The looming uniform monopoly. To really understand Cintas, you have to look way past the surface. On paper, sure, they design, manufacture, and launder corporate uniforms. They deliver floor mats, clean room supplies, heavy-duty shop towels, and they restock workplace first aid kits. Let's be honest, it sounds incredibly boring. But here is exactly why it matters. They are a structurally vital service for over 1 million business accounts across North America. Think about it from a client's perspective. Outsourcing all of this to Cintas reduces their annual per-employee garment costs by 30 to 40%. Why? Because it completely eliminates the upfront capital outlays and all those annoying repair overheads. It takes what is usually a massive logistical nightmare for a business owner and transforms it into a seamless weekly touchpoint. Essentially, they take transactional commercial spend and turn it into highly predictable, sticky recurring revenue. Section 2. The ultimate economic engine. Now, let's dive into the core driver of their profitability. It all comes down to route density. Cintas operates over 12,100 local delivery routes and roughly 850 commercial laundry facilities. Think of each local market as a highly optimized geographic radius. When Cintas adds a new customer along a route they're already running, the marginal cost to service that incremental client, the extra fuel, the couple of minutes of driver time, it practically approaches zero. The truck is literally already driving right past the building. This dynamic creates massive operating leverage. It is a fundamental, structural cost advantage that allows Cintas to produce operating margins that consistently double those of national competitors like Vestas. But look, getting the customer is only half the battle, right? Keeping them is where the economic moat really deepens. These uniform rental programs are locked behind 3 to 5 year contracts. They come with automatic renewals and some pretty severe early termination penalties. Plus, once Cintas actually integrates into a company's daily workflow, especially when they deploy tech innovations like their TrueCount RFID garment tracking, which guarantees 99.9% delivery accuracy, the administrative friction for a business to switch to a new vendor becomes entirely prohibitive. It's just not worth the headache. Furthermore, Cintas positions itself as an indispensable compliance partner. With escalating OSHA regulations around things like flame-resistant clothing and workplace safety, Cintas effectively de-risks corporate operations for their clients, which in turn fully justifies their premium pricing. And by the way, if this kind of research-first analysis is your thing, you'll probably want to subscribe. Section 3. The Evidence and Scorecard. Okay, let's look at the hard proof. On July 15th, 2026, Cintas released its full-year results. And honestly, they delivered record-breaking operational metrics. Consolidated revenue hit $11.26 billion, which is up 8.9% year over year. But the truly staggering number here is that gross margin. It expanded by 70 basis points to an all-time high of 50.7%. To maintain and actually grow that level of profitability in an environment battling both labor and fuel inflation, that proves they possess absolute pricing power. Adjusted diluted earnings per share reached $4.94, which is a 12.3% jump that comfortably beat analyst consensus. On top of that, they generated $1.88 billion in free cash flow. This right here is the ultimate hallmark of an asset-light, highly cash-generative system.
And the market reacted exactly as you'd expect to an earnings beat like that. Combined with their strong fiscal 2027 guidance, shares surged to intraday highs of $196.58, ultimately settling around $192.54. CEO Todd Schneider actually pointed out a pretty jaw-dropping statistic during the earnings call. Fiscal 2026 marks the 55th year out of the last 57 years in which Cintas has grown both its top and bottom lines. Let that sink in. That level of relentless execution commands a serious premium valuation, leaving the stock trading at a forward PE multiple of roughly 32.8 times.
Now, all of the research behind this explainer was created using Flash by StockSentinel.ai. You can generate deep research reports like this one for any public company in the world completely free at flash.stocksentinel.ai. The core company research is free. If you want an ongoing investing edge, Flash has a premium feature called Best Ideas Now. Every week, it surfaces the highest conviction ideas across 3 investor styles: long-term compounders for quality businesses built to compound for years, hidden gems for under-the-radar names with asymmetric upside, and dividend hunters for durable income with the fundamentals to back it up. Portfolio Watch monitors your portfolio and flags important changes. Insider IQ tracks meaningful insider buying activity worldwide. You'll see a QR code in the bottom right of this video. Scan it to download the Flash app and try it yourself, or access Flash on the web at flash.stocksentinel.ai. Pricing is going up over time, but once you lock in your subscription, your price never increases. Getting back to the analysis, let's synthesize all of this into a qualitative scorecard. The overall business quality is just exceptional, yielding a blended score of 8.8 out of 10. Market position and profitability? Those are absolute gold standards, scoring perfect 10s. They hold that 31% market share, systematically capturing business away from fragmented local providers. And as we saw, their margins are pretty much untouchable. Management alignment is also stellar at a 9 out of 10. The founding farmer family retains a 17.2% stake, which is worth over $12 billion, by the way, ensuring that their long-term vision stays intact. Really, the only major drag here is analyst sentiment, sitting at a 6 out of 10. Wall Street respects the operational execution immensely, for sure, but the consensus is mixed purely due to that demanding premium valuation multiple. When a stock is priced for perfection, any friction can be costly. Section 4. Risks and market concerns. So that premium valuation brings us to a crucial point. It leaves basically zero margin for error. The single biggest threat to this entire thesis is an outright FTC block of the UniFirst merger. If regulators step in and stop this deal, it deprives Cintas of its key inorganic growth driver and essentially caps its market consolidation right then and there. But even if the deal does go through, there is massive integration risk. Any delay or friction in merging those complex route networks could seriously degrade those $375 million in expected synergies. On the operational front, you also have to watch out for the EPA. Commercial laundry wastewater is heavily regulated under the Clean Water Act. Multiple municipal consent decrees could literally force plant shutdowns, which destroys that regional continuity they rely on. And finally, there's macro sensitivity. Cintas rental volumes are directly tied to customer headcount. If stagflation hits hard and clients start laying off workers, those high-margin uniform volumes are going to drop immediately. Section 5. 5-year scenario analysis. Before we dive into the numbers, I need to state clearly, this is a hypothetical framework for thinking about possible outcomes. It is not a prediction, and it is not financial advice. The stock could go much higher or much lower than any of these scenarios. All right, let's walk through the assumptions for the next 5 years. In our base case, we assume the UniFirst transaction successfully closes in late 2026. Those $375 million in synergies are realized, driving operating margins up and pushing fiscal 2031 earnings per share to $8.62. Applying a 32 times multiple gives an implied share price of $275.69. Now, in the high case, we assume integration is absolutely flawless and the broader macro environment booms. Revenue hits $20.29 billion, and that incredible route density pushes net margins up to 19.8%. EPS jumps to $10.31. Cintas keeps a premium 35 times multiple, giving us a higher implied price of $360.71. But the low case is where the real tension lies. In this scenario, the FTC outright blocks the UniFirst deal. Cintas has to rely on slower organic growth during a mild recession. EPS drops to $6.50. The complete lack of synergy and slower growth craters their valuation multiple down to 25 times, resulting in a share price of just $162.52. And hey, if you want to access the full model with all the detailed assumptions for each of these scenarios, you can check out the detailed research report over at flash.stocksentinel.ai. Now, when we break down the probability weighting, we assign a 55% subjective probability to the base case, 25% to the high case, and 20% to the low case. What this breakdown tells us is that the market is currently leaning favorably toward a successful deal close, despite that severe regulatory scrutiny from the FTC's second request. The baseline assumption for investors right now is that Cintas will successfully navigate the antitrust concerns and manage to consolidate the market.
When you mathematically blend those probabilities together, it gives us a weighted 5-year expected share price of $274.31. Relative to the post-earnings share price, this actually implies a very healthy 47.5% cumulative total return over the next 5 years, assuming, of course, that the math holds up and the core thesis remains totally intact.
Section 6. The final verdict.
As we wrap this up, there are 3 critical takeaways you need to remember. First, the incredibly boring nature of this business is exactly what protects it. Route density creates a structural cost advantage and an unmatched level of pricing power that regional competitors simply cannot fight. It's an impenetrable moat. Second, the $5.5 billion UniFirst deal is the ultimate catalyst for the stock. It expands their market footprint drastically, unlocking massive scale and synergy. But third, that exact catalyst is highly vulnerable. FTC scrutiny is undeniably the single biggest threat to this elite compounding narrative.
Which brings us right back to the definitive question you must track next. Will regulators step aside and allow Cintas to forge a dominant North American duopoly, or will these antitrust concerns cap the ceiling on this industrial juggernaut once and for all? The outcome of that single FTC decision will almost certainly dictate the trajectory of this company for the next decade. If you want the full research, including the deeper framework behind this explainer, you can get it free at flash.stocksentinel.ai. Until next time, do your own research, and I'll see you in the next one.
Check out Flash at flash.stocksentinel.ai to access free research and videos like this one for any company in the world.